everybody. I was just thinking, while I was preparing for this speech today, just looking at some facts about human beings. After all, infrastructure is, if nothing else, but something that supports Homo sapiens on this world of ours. And probably particularly relevant when you think about extension, the different rebellions that have been going on in town, bank station otherwise, extension otherwise. So one of the thoughts is there's 7 billion people in the world today. So I just wondered, actually, how many people have gone before? Got to know, that's a morbid thought perhaps, but actually, if we've got 7 billion and we're going to get more, especially if we're thinking about our kids and our grandchildren, actually what happens thereafter? Because we've got 7 billion children, we've got 7 billion people now, whatever. So it turns out the answer is there's 15 people for every one of us has gone before. Someone's worked out in Washington. I don't know if that's fake news or not, but let's take it at that. So the problem is that actually we've got a much greater concentration of people needing to live mostly in urbanised environments of some kind. And that's really interesting because how do we cope with that? How do we make that sustainable? How do we make that green? How do you actually get the money to the places it needs to go? I hope I don't get this button wrong. It's a big number. I've been working in the city since 1990. I started my career at Reuters, and when green screens were not green. They were very much not green, but they were green in colour. And 94 trillion to sustain us by 2040. Just try and think of that number. I find it quite difficult, having been around that long. When I started in the city, foreign exchange was traded in hundreds of thousands a day. It's now traded in trillions a day. 94 trillion of infrastructure building. That's to sustain us human beings. It's huge. No, that's the total number. The gap actually is somewhere between 2 and 3 trillion unfunded per year. Well, that was last year. So it's really interesting, isn't it? Because if you think about people moving out of agriculture, or you talk about, Belt and Road, you talk about the population of India, which is very quickly catching up now with China. It's only a few million people behind, but it's up to 31 million, it's up to 38 million. It's a massive top, but actually the question is how do we actually make that sustainable? How do you actually, how does the platform, how do we as a society, and I'm not claiming that EIX is going to solve the whole problem, but I'm saying how does property, how does real estate, how does infrastructure start to actually make a difference? How do we actually catalyse that? And we've got, if you look at the PE market, you've got something like, 2 trillion, 3 trillion, it nearly correlates exactly with the gap per year of money that isn't invested at all. And that's just the PE market. So if you take pension funds and other markets, it's even bigger. And now you've got the added benefit of a low yield environment. So the pension funds that we're all invested in, or some of you may be even receiving, are actually not making the money they were going to. Or if you go to the Munich Re, for example, they've got minimum return guarantees of 3-4% per annum. They're not hitting those either. They're all negative yields. So there's a real dilemma. But maybe infrastructure is an asset class. We've been living on heroin, as it were, with quantitative easing. So actually, how do we change that? So the EIX story, and I don't want to spend too long on this, but very simply is based on a personal experience. So I was doing, so my background was Reuters, then I worked for a risk management company, and then latterly built my own company, which I sold to Boston Consulting Group. And during the process of then moving on in time, I ended up doing a deal near Tower Bridge. And literally where the DLR comes out into the sunlight, it's actually finally being built, and it was built by IJM Land, which is a Malaysian company. £400 million worth of gross development value back in the day, 6-7 years ago. And the problem was is that HSBC in Malaysia wouldn't actually speak or think about what was going on in London. They were siloed. They wouldn't move the money around. So we ended up putting in place what you would call an overage deal. So the developer who'd actually got the optionality of that deal ended up having only to take profit at the back end rather than being able to take anything out of the hard work and go at the front end. And off the back of that, my thinking was, if that's going to be so difficult to get this money into the market, then how is it that we can get money with a view to start to speculate? Because prior to 2008, the banks had fundamentally said, I'll lend you 105 or 110% of the value of the deal at any one point. And all of a sudden, we were back into a debt and equity relationship. So the obvious answer is merchant banking. The ones that some of you in the room might remember very well, which was the ones that are, in my case, my great-grandparents would have run. I said they didn't, but if I had great-grandparents that were merchant bankers, they would have. Alternatively, it would be, some of it. So anyway, there were the people that really had the risk in the process that actually understood how to take a risk alongside you and walk towards the problem, not just be product orientated. But that wasn't going to happen. The regulator wasn't about to hand out those licenses, as we know. It was too big of an issue. So my thinking was quite simply go back in time, go back in history. And if you go back to the beginning to get money with a view, so the speculative capital that actually exists in family offices, in sovereign wealth groups, that actually wants direct access to market. Don't forget they've been hurt in the 2008 crash by actually funds, well, like the Woodford issue today, had been gated. Then actually how was that going to work? So my view is go back to the coffee shop, go back to the exchanges, go back to a place where people who actually can speculate and access money can do so. And it's really important because all the money in the market today is still pre-priced. So banks are pre-priced because they're over-regulated. So they're told that they can't lend more than 10 and they don't find it really hard to lend high. So they're probably stuck at 65% and somewhere between 8 and 10 years. And if you're a fund, you've promised someone a return because you wrote an information memorandum that said to somebody, this is the return I want to have. So where's the money with the view? Where's the money that's actually pricing the risk? It doesn't exist. Not in a systematic way that makes it scalable. So this is a way, an exchange, if you think about it, if you go back to the origins of what an exchange is meant to be about, actually goes back to what that is. It's about pricing risk for the view that you have of your money and the risk you're taking. So that was the nascent beginning. So let me just walk you through quickly the process by which a deal gets on the exchange. So imagine you're a government, imagine you're a private individual, one of you, wealthy, wants to get a waste-to-energy site, a bit of solar off the ground. That's you, that's the issuer. So whether it's a project that's public, private, or a mixture of both, so PPP, or indeed someone who is actually just simply thinking about refinancing. So it could be greenfield, it could be brownfield, it could be refinance, we don't care. It's about running towards the problem. So we then have, you'll know them if you work with the London Stock Exchange, you'll know these people as nomads, nominated advisors, that actually are CF30 people working within them, they're corporate advisory firms that are regulated by the FCA in London. So we're those are the people we work with, not the same people, but that status of people. And they carry out third-party due diligence to get a project onto the exchange. So what they do is they do the technical, financial, and legal due diligence. So the technical due diligence is obviously not done by them because they wouldn't have the engineering expertise to do that. So they work with ACOM or Arrow or Turner & Townsend or Montgomery, those type of people to do that work. And then under the rule book, which obviously all exchanges operate by, we end up with a grey market process. So this is the key component, because what it enables you to do is to test the price of something that's coming to market. And this is what's missing. If you go to a bank today and it goes to the credit committee will say, yes, it has happened, or no, it hasn't. But what they won't do is tell you why. But a third-party price discovery process, grey market if you like, will actually start to be able to inform you as an issuer what it is you're doing right or doing wrong. And that is critical. And it gives you three things. The price discovery memorandum that we issue will give you the coupon at par value of a bond. It will give you the depth of the market, i.e. the interest in the issue that you have. And the third thing it will do is give you the price that it will cost you to place that into the market. So you can, the to and fro of that will actually start to really tell you how that's going to impact your cost, benefit analysis, your tenor if you like, the length of time that you're looking for, and the price at which you can place it, and therefore your return as an investor. So to give you an example, we had a client at the moment who's already had deals priced through pension funds and done and put them away. But his issue, as someone who's developed all the technology, has been that he's been stuck by actually only getting a development return, developers, if you like, commission for his deal. And he hasn't actually been able to build his balance sheet. So he's done all the work, but actually he's getting none of the long-term benefit. Because the pension fund's gone, well, you know, I tell you what, I'll take over the O&M the long term. So they pay him a very nice bonus for delivering it on time. So he gets 2 bites of the cherry. But the asset value over time, over the 20 years that asset's in flight, he doesn't see any of that. So the reason he's come to us is to say, you know what, this is a really, you know, I can now build my own balance sheet by putting in the equity and you raise the debt for me. So after that, you then end up with an auction for the price and finally the placement. Now, the interesting piece is that this period of time would normally take you, for an infrastructure deal, would take you somewhere between 6, maybe 9 months to do. In our case, it's 16 weeks, and it will go faster. So we're very, very quick. And in terms of the speech today, if you like, in terms of where we're going in terms of future platforms for property, what's really interesting is it's about AI, it's about machine learning, if you want to come back one step, and taking the due steps that are due. And you can really begin to do the legals in a way that you've never thought of before. You can actually start to create the legals automatically. And the exchange gives you the framework within which that can happen. So I can create a bond as quickly as a machine can create it for me. The only things that change are the terms and conditions for it. So in due course, we can do it faster than the market can wear it. You can do it as fast as a computer can make it happen. So some of the sell down benefits. So if you imagine a couple of uses. So imagine if you're a fund manager and you typically are a 5-year close-ended fund. You would normally have your roll-on period and you'd have your roll-off period to end up back in cash. So with us, you could, if you wanted to, rather than go out and have a bilateral negotiation, you've got a 5-year close-ended fund, you've spent a load of money and due diligence getting all the assets on board, and actually at this point you're thinking, well, I wish I could hold them for longer, but I've got to sell them down because that's what the information memorandum says. With us, actually with certainty of capital behind it, you could come and sell those assets much later. So rather than having to sell, I don't know, a solar plant, a road, whatever you've invested in, you can now come and sell it in year. You normally start to roll off somewhere around year 3, you can sell it in year 4, maybe 4 year and a half. Your performance as a fund is going to go through the roof because what you modelled in the IM completely changed simply by holding it. That's massive. It's huge. The performance goes through the roof simply by holding the asset that you actually spend all the time buying and holding it for the time period that you wanted it. So for all of you that are in funds, that would be a real return, right? You're going to make a massive return differential because you know what your exit is and how you're going to execute it. There's nothing wrong with the asset. Just because a 5-year closed-ended fund is a 5-year closed-ended fund doesn't make it a bad asset, it just makes it a 5-year closed-ended fund. The other use is if you're trying to realign your portfolio. So we've already had this with a couple of people. So publicly listed funds trying to readjust their portfolio to keep them within parameters of risk, where they try to keep divvies, I don't know, 4, 5, 6, 7%, whatever it might be. Again, if they're trying to readjust, they don't want to necessarily sell the whole asset, they might just want to sell part of the asset. So how do you deal with that? So again, an exchange is a good way of doing that. You can proportionately sell something down without actually losing control of the asset that you hold. So it gives you another opportunity to do that. Something different. So the answer is for all this, well, that's why I call it merchant. It's really a merchant bank and it is, representing itself as an exchange. Because whatever you want to do, we can look at, because we're trying to run towards the problem and work with you. So that's kind of part of the future of where real estate needs to end up. I guess these are the things that you'd expect to see from any exchange. Why would you have, so our chairman would say, who's been in infrastructure for 50 plus years, would say the people with the expertise don't have the money, and the people with the money don't have the expertise. So what you're trying to bridge is, as the Baltic does to shipping, we do to infra. So we're a niche place to go. And this is the key thing, is to understand the asset class, not just in property, but in infrastructure in our case, is the key to actually answering the question that we've been put by James and Co. this evening. Because it is very difficult to understand how you create out of a physical asset a liquid proportionality. So how do you make it transferable? And obviously security is the way of doing that. So there's a couple of examples. So price transparency. So I was with the CEO of a major European port recently, and one of the things that came up was that he'd gone out to tender with financial companies to actually find out the cost of capital for a deal. And he went out to 9 institutions and he got a 500 basis point spread. So his basis point spread was from 2.5% for money to 7%. His issue was that his masters are political. So the question is, how does he then make a decision about who's right and who's wrong? It's really difficult. Because he goes to the cheapest money, that might be the cheapest money, but it might be the wrong money. Does he go for the longest tenor? But the point is he didn't know, because the spread is so wide. You wouldn't see that in any other market. And yes, this is one of the largest asset classes in the world. So an exchange allows you to create price tension to enable you to find out. You see it when whether it be Aston Martin that lists one day and falls the next, or whether it be any of the other stocks that we've seen recently who've fallen. The reality is that all of those elements are realities in themselves, but at least it's transparent. I mean, I remember with Royal Mail, for those of you who can remember, with Vince Cable was very much told off initially. The press was very negative until we found out that there was more news on the balance sheet on the Royal that actually enabled him to actually justify the price that the exchange had created on the LSE. So that price transparency is really important. Diversification. Well, it goes without saying, you would much rather, whether you talk to Aviva or you talk to Ontario Teachers or Aberdeen Standard, they would much rather have a constant flow of projects that enables them to have a small proportion of good projects coming through their portfolio, which allows them to be diversify than it would for them to take 200 million and invest it in one project. And that's why they become very proprietary about what they do. And that's the problem. At the moment, it's very, very proprietary in the sense of being subjective. And projects, therefore, actually going around and looking at what we do and how we do it is really, really difficult and costly. Standardisation goes without saying. We've got a bond, it's a bond, it's a bond. You standardise the rules, we've got a rule book, you subscribe to that, you're going to go. So it's got to be a good idea, whether it's for infrastructure or whether it be generically for property. You've got to be able to standardise your way you work so you can understand the term, the currency, the convertible rights, etc., and your own legal position. And we're only dealing with professional investors ourselves, but it would apply on a public retail market as well. Oh, I got it wrong. So I've talked a little bit about this already. I mean, for the project sponsors, it's really a matter of price tension. It's actually about the ability to be able to get the best price for the project in the market. But more importantly, as I said earlier, because the banks are lending short and IMs are lending where they are, the biggest problem they have is that they can't find long-term money. Now, I know there's some people in the room that are well below 40, but for those of us that are older, it would be a really nice idea to be able to have projects that provide a return ahead of us repaying the lenders. So if you can lend very long, the tenor is much longer, obviously the cost of capital is going to be lower, and that enables you to make a profit and grow the business. Now that was existing before 2008, it doesn't exist now. And I had someone in my room as a sovereign wealth group the other day. Admittedly, it was a AAA rated country dealing with a public-private partnership refinance, but they were offering 150-year money. Now, that is a game changer. And that's only available because they think that the flow of capital that's coming across the world is actually this way, can be done this way. So again, the transparency globally, so for example, in Australia, lots of money for the short term, no money for the long term. The regulator turns around and says to you, I tell you what, I want you to stop, you're the banker, I want you to stop being concentrated here, I want you to diversify your portfolio. So you're going to have to go overseas. Equally, the people over here who are now going into recession are thinking, well, I left in 2008, I'm not going back now, because I've got to put all these people over there. So how do you get there? So a platform begins to allow you to have access to a market you wouldn't have seen necessarily before. So it starts to really make a change in terms of accessibility geographically and politically. And it enables people to start to commingle, to diversify, and make things happen to meet the demand that I was talking about earlier, which is how do we survive and make 7 billion come to play? I'm not sure that's right. So just before I go on to that, one little story. So last March I was in Berlin, and they had the infrastructure investor conference. And Dr. Kim, who was the head of the World Bank, was speaking. He'd obviously just left and joined Global Infrastructure Partners. And I made a bit of a pain myself and followed him around the room until I got to speak to him. The question he was asked, he had one of those famous fireside chats, but no one had actually asked him the question that everyone wanted the answer to, which is why had he left the World Bank. And being me, I asked him the question. And he said, actually, he was very nice, he was a very modest man, and very welcoming. And he's just simply said, he said, you know, my parents come from Korea. And when they left Korea, they were both lucky enough to get sponsorship to go to university in the United States. So when they arrived in the United States, they'd never seen a picture of the United States, they didn't know what to expect, whatever. And their view of life, what was going to happen, rose in expectation of what they saw and what they experienced as they were at university. They obviously didn't do a very bad job as he became head of the World Bank. But he said, the problem is today is that we all have a mobile phone. So when you want to look at somewhere nice, New York, London, Paris, take your pick, I can see it on my mobile phone, I can see it on the internet. I don't have to go to university in New York or Stanford or wherever to see it. So obviously my wish is, as an individual sitting in a country where I've got less opportunity than you, is to go to that country. But what's interesting about that statement is, he just said, so we need to establish 3 things faster than the International Development Banks can deliver. And that's energy, transport, and specifically broadband. And we can't do that through effectively government capital. It takes too long. It has to be done through some sort of mechanism that delivers that money. And I think that's really important, because if you think about it in terms of impact, ecology, green, etc., all those elements start to bring together. Now, as a final sort of point, apart from our pipeline, etc., we have a data business, and I know I'm not going to spoil some of Pete's thunder. But what we've had to add to this, so I had expected when I set this business up to be able to just take a data feed of our deals, plug it into the back of a Bloomberg or Refinance terminal and carry on. Unfortunately, both those big players actually provide very little infrastructure information at all of any meaning whatsoever. So we've built a team. We've got journalists, we've got a data team of people who've built effectively a web app, as we call it now. I keep on being told off for calling it a terminal. Which effectively is a Bloomberg piece of kit for infrastructure. And we're just launching this at the moment. And we have about 15 years worth of procurement information married to 15 years of share data and news, etc. And that really is what enables, because at the end of the day, I can throw all the data at you in the world, and we can throw all the models, and we can all make the statistics and models work beautifully, because if we want them to, and look the way we want them to be. But in reality, you need the information to be able to interpret it, to make it intelligent, and to give you the ability to make decisions. And that's what this does as well. Do you want to add anything? Just to let you know, just some numbers at the end. So, as a pipeline, we've seen, so we started this infrastructure pipeline in September 2017, so just under, or just over 2 years ago. So we've seen over £36 billion worth of projects globally. So they include Australia, South Africa, Latin America, Philippines, Southeast Asia generally, Canada, etc. And we've hard filtered that down to 11 billion. That's 3 billion of projects that are available today, and 11 billion of follow-on. So it's slightly higher than the number suggests. And that will change. That's anything from a road that's being refinanced in Chile that was financed by a bank as a bond, to a greenfield site which is bioethanol. I had a chemistry lesson earlier today, which reminded me of Knowles and Edens, which I've forgotten about, to, I suppose, things like hydro, etc. So it doesn't really matter what it is. The point is, and the point I'd like to leave you with, is just to run, rather than be product-based, the future of property exchanges or property platforms is all about trying to run towards the problems and trying to make them liquid, trying to make the asset transferable. By that I mean liquid and tradable. And in the end, is to really try and think about how you create a mark-to-market. How do you actually, day to day, when you've got an asset portfolio, say, this solar pump, this solar position, this nuclear fund, whatever it may be, how do I market to market on a regular basis without having to go to an accountancy firm and have to do a director's sign-off? Maybe that's the future. I hope so. I'll leave that the rest of it with you. Thank you very much.